Hello everyone, today we'll be discussing the Q1FY17 earnings preview for the consumer sector. After a dismal show for the last two quarters, Q3 and Q4, we expect the earnings growth to revive slightly in Q1FY17. Now it is to be noted that this revival will majorly be optical. It will be because of a lower base, because if you look at ground level, there is nothing which has actually changed when it comes to the demand environment. It should also be noted that most of the companies will be reporting results from this quarter in the new Ind AS format, due to which the reported numbers will not be comparable to the numbers which were reported earlier. There will be many themes which will be prominent in the results of this quarter. We'll discuss these themes one by one. The first theme is rural slowdown. We expect demand to revive only post monsoons, which is Q2FY17. So we expect demand environment in Q1FY17 to be sluggish, and hence the growth rates will not improve versus Q4FY16. The second theme is cessation of excise benefits. If you look at the three companies, HUL, GSK Consumer and Colgate, their sales growth rate were hit by around 100 to 600 bips because of the cessation of the tax incentives which they were getting. And as a result, the FY16 numbers have a very low base, due to which the FY17 numbers will start looking optically better because this impact is already there in the base. The third theme is the price cut cycle. We expect this cycle to actually come to an end, at least for the food related companies. We've seen a series of price hikes by Britannia in some of its SKUs, and we feel that all these companies will gradually start hiking prices or reducing grammages in various SKUs. Now also, because of the sudden rise and significant rise in the price of sugar, wheat and some other agri commodities, we expect the margins of various food companies to be actually hit because of this increase. The fourth theme is confusion over the large pictorial warnings. Now this pertains specifically to the cigarette sector. We expect the growth rate of ITC to be slightly impacted because of the confusion regarding the large pictorial warnings. From our channel checks, we had understood that in some places the government authorities had seized goods of a few distributors in Maharashtra. But in spite of that, overall we feel that the volume decline cycle has actually bottomed out, and in this quarter we expect a flattish volume growth, but from next quarter onwards we expect the volume growth rates to turn positive, and because of this we expect the earning growth trajectory to start moving upwards, and ITC should actually start showing better numbers, better financial and operating performance from Q2FY17 onwards. Coming to our top picks to play in this quarterly season, our top picks are ITC, Dabur and GSK Consumer. ITC because we feel that the operational and financial performance cycle will actually start becoming better from this quarter onwards, and even in this quarter we'll actually see good numbers. Dabur because of the low base, as well as because of the advantage it is getting from the overall increase in enthusiasm in the natural Ayurvedic segment. And we also like GSK Consumer because we believe that from Q4FY16 onwards the company has started focusing on volume growth, which we believe will actually be very positive for the company, and it will actually drive earnings growth. The stocks which we believe will not do in this quarterly season are HUL and Nestle. HUL we feel because of various reasons. Number one, they had reduced the distributor margins, due to which the distributors have reduced the credit period in the system. We feel that this will impact the sales number. Second, the Q4FY16 base is already very strong because of the additional inventory which they had given to a few distributors. And the third reason is because of the overall slowdown in the market, which will impact the soaps and detergents growth. We are also negative on Nestle because we feel that the growth rate numbers by the consensus is very optimistic, and we believe that the valuations of the company are also very high compared to the overall sector average, and we believe because the growth rates do not seem to be so attractive, we feel that it does not deserve such sky high valuations. Thank you.